Now, central banks are the most powerful institutions you were never taught to question. They rarely make headlines. They rarely face elections, and most people cannot explain what they actually do. However, central banks control the price of your money, the fate of your economy, and the value of everything you have worked for. They can create wealth out of nothing or erase it overnight. And the strangest part is that they never answer to you. This is the story of how central banks began to manage modern finance, not as neutral referees, but as active players in a game they helped invent. This is the story of hidden power, financial engineering, and the illusion of stability. And once you understand how it all began, you will never look at your salary, your debt, or your savings in the same way again. Let's go back to 1694. England was bankrupt. The crown had fought an expensive war against France, and the treasury was empty. This was not a bank as we think of it today. It did not exist to serve citizens. It existed to finance the government and make a profit by doing so. This is exactly the origin of the modern central bank, not as a stabilizer, but as a lender to the state. And over time, this power slowly grew. By the 19th century, central banks across Europe had adopted similar models. Privately owned institutions with special privileges. They issued currency, they controlled reserves, they rescued governments in crisis, and in return they gained extraordinary influence, usually without democratic oversight. In the United States, the story took a more difficult path. Americans had a deep suspicion of centralized financial power. The first and second banks of the United States were both closed after political battles over corruption and elitism. For much of the 19th century, the United States had no central bank, and the financial system was a wild mess of private currencies, speculative frenzies, and violent panics. But after the Panic of 1907, after a crisis so serious that private financier J.P. Morgan himself had to coordinate a rescue operation, the pressure increased. In 1913, Congress passed the Federal Reserve Act, creating the Federal Reserve System. It was presented as a decentralized network of regional banks that would stabilize the economy. In practice, however, it became a centralized authority with enormous power over interest rates, credit, and the money supply. And this is exactly where the story gets darker. The Federal Reserve is not a government agency. It is an independent institution with both public and private elements. Its board of governors is appointed by the president, but its member banks are privately owned. It is financed not by taxes, but by interest on government debt and fees it collects from banks. It operates in the shadows of financial markets and makes decisions that affect millions without any real voter input. So who does this system serve? Officially, the Fed has a dual mandate: maximum employment and stable prices. But unofficially, its actions often benefit the same institutions it is supposed to regulate. During the 2008 crisis, the Fed did not just lower interest rates. It printed trillions, bailed out investment banks, supported asset prices, and guaranteed toxic debt. In 2020, it did it again. It bought corporate bonds, pumped liquidity into markets, and inflated asset bubbles that made the rich even richer, while everyone else was told to wait for prosperity to trickle down. Here is the deeper truth. Central banks do not just control the economy, they shape it. They choose winners and losers. When they lower interest rates, stocks rise. When they tighten, markets crash. When they print money, asset owners become richer. When they raise interest rates, the working class pays more for mortgages, credit cards, and car loans. And while claiming to be independent, central banks are deeply intertwined with the very financial system they are supposed to oversee. Their leaders move in and out of investment banks. Their policies often reflect the interests of Wall Street, and their language, deliberately wrapped in ambiguity and technical jargon, keeps the public in the dark. Today, we live in a world where central banks are more powerful and less accountable than ever before. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England. These are not neutral institutions. They are the architects of our monetary reality. And since 2008, they have transformed the economy into something barely recognizable. Low interest rates became the norm. Quantitative easing, once unthinkable, became routine. Central banks printed trillions to buy government bonds, corporate debt, and even mortgage-backed securities. And the result was that asset prices rose. Stocks, real estate, commodities. For those who owned assets, it was a golden age. For everyone else, it was inflation disguised as prosperity. Housing became unaffordable. The stock market became detached from wages. While savings earned almost nothing, the cost of living rose, and most people did not know why. They blamed politicians. They blamed immigrants. They blamed bad luck. But they did not blame the invisible hand directing the money supply. Here is the hard-to-believe truth. The modern financial system was not designed to set you free, but to keep you moving. Central banks grease the wheels of consumption. They reward debt. They punish saving. They manipulate rates, control narratives, and move trillions with the touch of a keyboard. And all of this, every meeting, every press conference, every emergency intervention, is framed as stability. But what they protect is not your stability, because the game is simple. When things break, the central bank steps in not to save people, but to save the system. The system, the banks, the asset owners, the machine. Look at what happened in 2020. The COVID crash triggered the fastest collapse in market history. Within a few weeks, the Federal Reserve created more than $3 trillion in new liquidity. Stocks recovered. Billionaires doubled their wealth. But millions of workers lost their jobs. Small businesses died. Renters faced eviction. What was rescued was not the economy. It was the illusion of power. The balance sheet expanded. Debt grew. And the cycle of dependence deepened. And this matters because when central banks distort the cost of money, they distort everything. They make it harder to price risk. They make it harder to save. They make it harder to retire. They fuel bubbles. They trigger crashes. They create a roller coaster economy where real wealth becomes harder to reach and paper profits disappear overnight. And worst of all, they remove agency. Most people do not even know that they are being affected. They do not realize that the interest rate on their student loans, the return on their savings, the price of their homes are the result of decisions made by people they will never vote for in rooms they will never enter. So who controls the central banks? Officially, they are independent, but in practice, they serve the system that created them. The banks, the markets, the established financial class. The revolving door between Wall Street and central banking is not a conspiracy theory. It is a resume pipeline. And the language of central banking, uncertainty, academic tone, technical reports serves one purpose: to keep outsiders out. But you are no longer an outsider, because when you understand how the financial system is structured and how central banks enforce that structure, you can begin to free yourself. Financial education is not just about budgeting or investing. It is about power. It is knowing that money is not neutral. It is knowing that inflation is not random. It is knowing that interest rates are political. It is knowing that freedom requires understanding the system and stepping outside its traps. This may mean holding assets that cannot be printed. It may mean creating income streams that are not tied to debt cycles. It may mean rejecting the idea that prosperity comes only from growth, because growth fueled by endless debt and constant consumption is a treadmill. And the faster it spins, the harder it becomes to stop. So what can you do? Start by clearly seeing that central banks are not gods. They are players. And their tools, interest rates, liquidity injections, asset purchases were not designed with your freedom in mind. They were designed to stabilize markets, protect institutions, and preserve the architecture of a fragile, debt-fueled economy. You cannot fight this system directly, but you can position yourself outside its reach. Diversify, simplify, reduce your debts. Own what matters. Learn how money works. Teach others. Question the narratives. Because when the next crisis comes, and it will, the central bank will do what it always does. It will protect the system. Protecting yourself will be up to you. History does not repeat itself, but if you do not understand it, it will still crush you. If this gave you a new perspective, subscribe. The answers are in history. I will show you where to look.